against the expected return of the portfolio. Obviously, if beta is 0, expected return of the portfolio is equal to the risk-free rate. It's going to be something like that. Okay. This says, let's say this is 1. That means this is the market portfolio. One thing about security market line, if you did the slope equal to market risk premium. I'm going to shorten that into MRP for later purposes. That's what securities market line is. In equilibrium, all portfolios have to land on that line. Okay. If a portfolio has beta of 0.5, it needs to land there. If a portfolio has beta of 2, it needs to land there. Things are not to scale, so don't worry about it. But what if somehow in the market, let's put a portfolio above the securities market line. Somehow we find that using our own information set, expected return is higher than what is implied. Let me use what is implied by the securities market line or the CAPM equation. This means there is too much reward compared to what it should be in equilibrium. If there is too much reward, what are the market forces? This reward to risk ratio is going to be higher than other securities. There's going to be more demand for the security. What happens when there is more demand for the security? Price goes up, which means this stock is now what? Underpriced or overpriced? Underpriced. Okay. As it is now, expected return is too much. Market forces is going to increase the price. If you increase the price, expected return is going to come down. So these are underpriced. So anytime you place above the securities market line, you are underpriced. Obviously, any portfolio that places below, they are overpriced. Right? And basically, there are two empirical implications from the CAPM model. One says securities that are exposed to more systematic risk are expected to provide higher returns. And the relationship between risk and systematic risk and reward is also linear. Basically, those are the two implications of CAPM. Well, let's find out if that is empirically kind of is the case. There is a database maintained by Cam French. So I'm going to just type Cam French data. For example, I'm going to look at portfolios based on size, the market cap. Let's get to CSV. Come on. Let me first save this as an Excel file. Okay. And let's call these decile. These portfolios, I'm not going to worry too much about these. So let's hide those. The way these returns are calculated, at the end of June of each year, starting in 1926, you sort existing stocks based on their market capitalization. The 10% smallest stocks, let's say there are 1,000 stocks. I'm going to take the 100 smallest stocks, put them in decile 1 portfolio, the next 100 in decile 2, so on and so forth. And I'm going to hold these portfolios for 1 year. And next year, I'm going to repeat the exercise. This is kind of a dynamic strategy. Well, let's calculate. And these are value weighted, which means stocks, if you have two stocks, one has a market cap of 100 million, the other has 200 million. The stock with a 200 million market cap will have double the weight on the portfolio. Insert. Let's calculate their average return historically. These are already in percent form. So negative or 1.13 means 1.13% return. The decimal would be 0.0113. Okay. Let's make this big enough. First thing we see, and these are monthly returns. Okay. Just to relate to them, I'm going to multiply these by 12. Actually, I'm going to make them into 1 plus divided by 100 raised to the power 12 minus 1. So these are 1 year compounded returns. Now, if you follow this strategy over the last almost 100 years, if you kept the smallest stocks, you would have made an average of 17.25% return. But if you did the same thing with the largest decile, you would have made only 11.6. That's a big difference. Okay. I mean, I'll insert, over 100 years, if you invested $1 at this rate for 100 years, that would have grown into 8.1, $8.2 million or so. Come on, man, work with me.